Good morning. The BRICS countries are Brazil, Russia, India, China, and South Africa. And this organization now has another dozen countries that are either in or on the way. And the major draw for countries who join with the BRICS is their development of a new global trading system, which is completely independent of the US-led system based on US dollar trading and the SWIFT bank system. The system that we use in Western countries, that one which is trade denominated by US dollars and executed by Western banks, that has obvious advantages to us and obvious disadvantages to everyone else. If we're honest with ourselves, there is no logical reason why a farmer in Brazil who's selling soybeans to China should use an American bank or the exchange in Chicago to make the deal happen, or need US dollars to do so. US banks would be paid to convert Chinese renminbi to US dollars, then charge Brazil for exchanging USD to real. It's slow, it's expensive, and that is the system up to now. And that system is going away. There is another feature of this arrangement that's also very advantageous to operators inside the system, which is price discovery. Decision makers across the world can see markets. We can see that China just bought 1 million tons of soybeans from Brazil because our people executed the trade. We can see the contracts because we created the contracts and put them on our own exchanges. We can see the prices, which are being updated in real time on our screens. Now, China, Brazil, and the other BRICS have the technology to build their own system, buying and selling directly, without US dollars, without Western banks, and without going through commodities traders and going through exchanges in Chicago. So as all this business and this global trade moves toward the new BRICS trading systems and out of ours, we don't see the prices anymore. We don't see the real global demand. We don't know where the supply is coming from to satisfy the demand. We are flying blind because the information feedback loops that we build into our systems, those are gone. And this transformation of global trade to a non-US dollar denominated system outside SWIFT and with immediate settlement, this is going to hurt all of our producers in the extractive and agricultural industries first. Oil companies, miners, and farmers. Every planting season, each spring, farmers across the world play the oldest and biggest poker game. They determine what they should plant that is going to bring in the most revenues come harvest time. To do that, they need to make a series of well-educated guesses with respect to their own costs, what other farmers around the world may be doing, and they need to have a good feel for what global demand is going to be. Farmers in North America and Europe spend a lot of money for professional advice and for the best information as to what is happening right now. And then they watch the futures markets very carefully for any news that's going to impact the prices of what they have growing in their fields. And we know what's been happening to their input costs. They're going up by a lot. Across the board, everything costs more on the farm. So it becomes crucially important to get the rest of the forecast right because they're already operating on thin margins. This is a strong analysis, and we'll begin with their conclusion. 2019 was the first time that the United States had a trade deficit in agriculture. Since then, we've run big trade deficits in agriculture for 4 out of 6 years, and this year we will hit a record. What has always been true? That the United States is the breadbasket to Europe and to big chunks of the Northern Hemisphere. American farmers can feed the world, they say. Now we can't feed ourselves. We're importing more than we're exporting. That's what a trade deficit is. Here's the chart. The blue line is U.S. agricultural exports running above the orange import line forever. They crossed 5 years ago, and now they're diverging fast.